Hey, Dustin Tibbetts here with Passport to Wall Street. Today we're going to talk about the importance of the 200-day moving average. Now you hear about this a lot. You'll see this on the financial media. A lot of technical traders, they like to use the 200-day moving average as well. But let's go into it and kind of see what does that mean. Let's look at some charts and see how this all works. Well, first of all, the 200-day moving average we look at on a daily time period. So if I go over to some charts here, I'll start with the S&P 500. This is the ETF for the S&P 500, the SPY. Now, traders, technical traders, like to use what is this red line, that's my 200-day moving average, as a sort of measure of the mid to long-term trend. Is the overall trend strong and healthy? That would be something over the 200-day moving average. Or are we looking a little bit weak, which would be something like Under Armour, which is under the 200-day moving average? That's really sort of this massive barrier to go from bullish to bearish. And so a good example would be the current markets. They have managed to hang on to their 200-day moving average. This is the SPY again. And that's so important. Technical traders that use this go, okay, we've been a little scary here in the short term, but for now we're holding on to the 200-day moving average, and so everything is fine. If we go on over to the Qs, the NASDAQ 100, same thing. Although shaky here in the short term, most traders would agree that the current markets are still holding strong above the 200-day moving average. Now, as we look around here, I want to scroll through a few names because we're going to go through the sector ETFs, like the emerging markets ETF, holding the 200-day moving average. Transports, the transportation sector, holding very nicely to the 200-day moving average. So as we look around at stocks that or sectors that were strong and have fallen, they all have managed to stay above their 200-day moving average. If they were already weak, or for example, you have a stock like Under Armour that really sticks out lately as being already weak, well, now that's going to be the ceiling that it just can't get through. We're going to need some good news. We're going to need follow-up on how the company is performing better, much better than they currently have. So keep that in mind. If you're looking for a simple way to just start investing and know that you're headed in the right direction, look for stocks that are above their 200-day moving average or currently moving above that average as sort of a starting point. It's very, very difficult to be a bullish investor or even a bullish trader on a stock that is under its 200-day moving average. So I hope you find that interesting. A little bit basic, but really this is such a great time to do this video because we're really starting to see not only the markets but individual stocks really fight and come up against that 200 moving average. Hey, thanks for watching. We'll talk to you soon.